Since we've never actually talked about this, I don't think, I thought I would use the option risk calculator Monte Carlo simulator that I like to use to talk about the actual raw probability of the road trip trade itself. For any of you that may have had me as your mentor at another venue, you may remember that I'm real big on probability. Because, let's face it, folks, we don't like to admit it, but we are gamblers. Simply by virtue of the fact of being an option trader, to some extent we are gamblers, and we're looking for an edge. Instead of the edge over Caesar's Palace or Harrah's, we're looking for an edge over the market makers and the algos and the high frequency traders. So we do anything we can do to get an edge, but first we have to know what the basic probability is. So this is a simulator that I like. I'm going to move that up there. And so there's the URL. This used to be Java Linux, but then he changed it, and he has made a couple of improvements, and he has now really improved the instructions on this. I really like the way that he has set this up now, and it's free. There are maybe 2 or 3 other free Monte Carlo simulators, but I don't like them nearly as well as I do this one. And I've corresponded with this guy. He's a pretty good guy, and he's very sharp. If you want to spend a lot of money, you can pay for a Monte Carlo simulation software, which will have all kinds of bells and whistles. But I didn't do that, because I don't think I need that. This is the URL, and when you go to the home screen, this will come up, and the fields that are in red, these are his reds, not my red, are the mandatory fields. And since we're using the SPX, these are the only ones that I actually fill in. If you leave the start date blank, it will start on today's date, whatever date that you're doing this. And then you simply come down and start to feed in the strikes, and whether it's a put or a call, and the number of contracts, and the premium that, for that option. I use the mark, and you'll see what this will look like. And it takes a few minutes to put it in. And if you want to have a hybrid road trip trade, like say you were doing a 6 lot and you only wanted 5 at the upper strike and then 1 on the strike that's a little closer to the money, you can put that in. I think that Edward asked if you could put a reverse Harvey in. Well, you can, of course, at the outset, but that's going to change the probability characteristics of this. That is not the information that I'm seeking from this. So I simply put in the strikes, number of contracts, and the premium for whatever cycle that I'm using. And what this does, and you'll see the way it looks like in a second, is you get an overlay of the log normal distribution of the underlying vehicle. Actually, I think that's just a normal distribution curve, a bell curve. It might be log normal. It's kind of hard to see from the way that he describes it, but from looking at the curve itself, I think it's just a normal distribution, a bell curve of the underlying vehicle, which in this case is SPX. And it'll be in gray. And then there will be the payoff curve, as it's called. And this is going to be the P&L of the trade at various prices of the underlying. And this is calculated, of course, from the Black-Scholes formula. The way that the calculator models this is the same assumptions as the Black-Scholes, that we have so-called geometric Brownian motion, meaning that, on any given day it might be up 3% or down 3% from the previous day, and there isn't any bias in terms of which way that the market is moving. When this does the simulation, and it'll do 100,000 times, so it'll be 100,000 possible price paths over a 3 standard deviation range. So in other words, it would be like doing the trade 100,000 times with no stops, no adjustments, no additions, no subtractions, and no layers, and no exits. So just the pure probability of what's going to happen. All right. So let's look at a couple here. This is on the 31 August, and these are real numbers that I used. Not the one for the trade, because I did this at the close of trading yesterday. I did this. I mean, I put this, together at the close of trading. No, Thursday, the close of trading Thursday. So let's look at a 50-80. And so this is the payoff curve in red. And you can see, lo and behold, to no surprise, it looks like a standard road trip trade curve at expiration. And you can see down here, these are the strikes, 23.90, 23.40, 22.60. I did a 6 lot. Those are the mid prices at the close, at the end of day. And the volatility for this cycle, not the average volatility for SPX, but the volatility for this cycle is 12.1, at that time on the 15th. You can put in some sort of a growth rate, but I don't usually do that. I leave that blank. So then that fills in what I put in for the risk-free rate, which I use the T-bill rate. So that's less than 1% for a T-bill. And this is what it will cost, $540. This red line is going to be $540 down below the zero line, of course, just like a regular road trip trade. For the examples that I'm going to show, I tried to get them all at a Reg T margin requirement of 18,000. Several things to look at here on the expiration graph. So you can see this is going all the way to August 31. I'm going to, on the next slides, I'm going to go to 15 days prior to expiration. But this is the expiration. Now notice that the payoff curve is sitting entirely within, with the exception of that little blip, it's sitting entirely within the normal distribution of the SPX in gray. And by the way, these are 1 standard deviation and 2 standard deviation. I asked him to put these in several years ago, and he did, and it makes it look really nice. When this first came out, he didn't have anything there. And by the way, this is the software that I used when I was developing the Weirdor. This is what actually convinced me of the value of the Weirdor. And some of you may remember, or you may have chosen to forget, I don't know, my presentation at another venue, on the Weirdor. But this is what I used, and it made me a believer, and this makes me a believer. When you have the payoff curve that is sitting entirely inside the 1 standard deviation of the bell curve of the underlying, that's actually not a good thing. But still, as we'll see in a second, this is, even if you let this expire and use this curve, you're still going to have a positive expected return. And it's going to be around $900. And you might say, what? I mean, how can that actually be happening? Because most of the payoff curve is sitting inside the bell curve. Well, so if you think about this for just a second, and you need to remember, we're going to be simulating this thing 100,000 times. Nobody here listening to this is going to live long enough to do this 100,000 times. Well, I might, but I don't think anybody else will. Okay, I'm only kidding. But when you think about it, see, you're going to have thousands of trades over here, and the most you're going to lose is $540. I mean, you're going to have thousands of trades, and you're going to have a few trades that you're going to lose the entire 18,000, not all that many, and you're going to have quite a few where you're going to lose maybe this much, but you're going to have quite a few where you're making big bucks. And when you add these all up as we'll see in the next slide, you're going to make about $900. So now we're going to go ahead and do the simulation. And this is, when you do the simulation on the actual software, it's just, one click. And then it will say it's going to do it 100,000 times. And it will ask you if you want to reject the outliers that are beyond 3 standard deviations, which I do allow that to reject those. Now, some people might say, well, if you're going to do just a pure probability analysis, you shouldn't really do that. But I think for practical point of views, from a practical point of view, I actually want to reject those outliers. So when you do this, you can see down here that your mean P&L, and again, this is for the expiration, is a positive $910. That's the same as the expected return. So the mean P&L means the expected return. And I would challenge anybody to find a strategy that's going to get the kind of expected return with no adjustments. But we need to say that you have a low probability of break even. And so that means that you're going to have a low win rate. And most of us are not going to want to accept the big drawdowns when they did occur. They won't occur too many times, but they will occur. Most of us are not willing to accept that. This actually does have a low probability of break even, and you can see that because on the x-axis, this is expressed as a percentile. So in other words, for right here, which is the break-even area, that means that 7% are below this, and 23% are above this, and therefore you have a break-even of 23%. And the other thing to note on this one is you have a very, very broad range where you're going to lose the entire 540. And you'd expect that from the payoff curve. Okay, so now let's go to a 50-80, but we're not going to take it all the way to expiration. We're going to take it to the 15th of August. So the same setup, the same risk-free rate, same strikes, same everything. But notice now that we have a fairly large area of the payoff curve, that's the red curve, that is sitting above and outside of the bell curve of the underlying. So I'll go back and check this one. See it's sitting inside here. Now we have this area sitting outside. And also we have a range over here where we're making money. If you go back to the expiration curve, slightly on the right side, we never make any money. But now we are making money. And this is going to really improve the performance. So this one again, it's same butterflies, so it cost $540, which is only 3% of the margin. So this would have met the road trip trade entry tool criterion. And now when we do the simulation, you notice several things. We still have a very good mean P&L or expected return of $894. We have a much narrower range where you lose the entire $540. But now you have the probability of break even at nearly 58%. And once again, I would challenge anybody to find a strategy where you have that sort of probability of break even when you do a simulated trade 100,000 times. And the other thing to note is that you actually have a very low chance, actually less than 10%, chance of suffering a major loss. So there's the 10th. So there's the 10, and so major loss would be from, say, there to there, I would say. I mean, you can have a loss up here, of course, but a major loss. So we already know that, but it's actually good to see this on the simulation that you have a very low chance of a loss. And once again, this is assuming you do nothing. So obviously, we will do things if we start getting under the tent, but this is assuming you never do anything. Now, what this also says is that you don't want to be too quick to adjust if the market starts to move down, because the probability is actually on your side. And if you come over here to the 60th percentile, you have about a 40% chance of making more than $2,300. And once again, this is from doing nothing. So that's actually pretty good numbers, I think. So let's now go through very quickly just a couple of other examples, and this will be set up the same way. So now we have a 40-60. I'm doing a 9 lot to keep this at the Reg T margin of 18,000. This is going to cost less, but the payoff curve is very, very slightly shifted to the right. And I would ask you to focus for now on that area right down there around the 2200. And I'm going to go back now. Notice that this is sitting right at it. And now when you come down here, it's a little bit on the inside. And if you go to we'll say the 2250 area, this is where the payoff curve is. And when you come down here and go to the 2250 area, very, very subtly shifted to the right. And this doesn't mean that it's not going to work. What it does mean is that you have a little more downside risk. And then when you do the Monte Carlo simulation, you get a slightly lower expected return by a couple $100, but basically everything else is about the same. You have a little more downside risk. Again, if you remember where the break point was, this is at around, I don't know, maybe the 12th percentile, and this one you started to break at I don't know, it's very close. But you do have more downside risk. And this is because the payoff curve has been shifted to the right. So this explains why I would rather do a 50-80, 50-75. Now, let's see what happens very quickly when you move the short strike a little closer to the money. Let me go back up here to show you that this short strike was at roughly 3.8% down below the money for the 2340. And if you come down here, now we're only around 3%. So it's moving the short strike now closer to the money. Look what happens to the payoff curve. So now it is now shifted on the inside of the bell curve. So this is dangerous. And you can see the shift even at this area. Now you do have a little more of the curve above zero here, but you have to say, is it really worth it? Because I don't like it when the payoff curve is shifted inside the bell curve. And when you do the simulation, your expected return is now really low, $377, still positive, of course. And now look at the break point here where you start to begin to lose some serious money. Instead of being at the 11th percentile or the 12th, you're at about the 15th. But you still do have the same 40% chance of making, say, 2,500 or more, because if you look at the 60 percentile, that means that 40% are above that. So you still have a really good chance of making a lot of money, but you're taking more risk. So what are the conclusions, just to finish this up? I've already mentioned that you're not going to find many, if any, strategies that are going to give a positive expected return based on probability alone, with no adjustments, no stops. And I would recommend for homework that you may want to try some simulations using this simulator of condors, either ion condors or regular condors. You can try some at-the-money symmetrical butterflies. I think you'll be really surprised there. They're really not really good on a probability basis. Calendars are terrible. Diagonals are a little better. And it might be fun for you to do that. And you may indeed be shocked. I know I was when I first started doing this. That was the reason that I came up with the Weirdor, because I used to be a Condor trader. Now, you also observe that different wing widths and short strike placement are going to have some major changes on probability. These graphs are going to vary significantly when the volatility cranks up, and it'll be in your favor. The payoff curve will look really sweet when the volatility cranks up. So another way of saying this is when we have a low volatility environment like we do now, you're going to have a leptokurtotic type of distribution of the SPX, meaning tall and thin with narrow tails. When you have a high volatility environment, it's going to be a little more platykurtotic. It's going to be short and fat with some broad tails, but the payoff curve will be better. More of the curve is going to be sitting outside the bell curve. It'll be really sweet. So as we already know, the highest returns are sitting below the mean price of the bell curve. We expect that. That's because that's the way we set it up. We know that if you come too close to the money, you're going to have more risk, and really you don't get any apparent benefits for the amount of risk that you're taking. So now to answer some questions about why we do what we do in terms of the adjustments we do, well, I think you can see now from an understanding of the probability analysis that what we're really trying to do is to increase our edge by raising the right side of that curve, so that we're minimizing this area right in here, or even better, this area where we would lose the entire cost of the butterfly. We are trying to narrow that range as much as we possibly can without really significantly changing the probability performance characteristics of the rest of the curve. So in other words, what we're trying to do is to change the shape of the payoff curve, but we don't really want to make it shift to the right very much, because once again, a shift to the right, that increases our downside risk. So that explains also why we make these adjustments, very gradually, because we don't want to have a sudden shift of the payoff curve to the right. And we do the adjustments over a 30-day, maybe a 40-day period to get the right side of that payoff curve up. For homework, if anybody likes to do this sort of thing, and I would encourage you to do that, but of course that would be totally up to you, but I would recommend that you run the simulations and vary everything. I would recommend that if you have the capability of option view or some other back trader or some data going back in time, that you try to plug those in. Maybe pick a period where the volatility is a little bit higher. Take a look at the payoff curve relative to the bell curve, and you can play around with where you put the short strike. And you should also take a look at some other strategies and see how badly that they're going to perform on a probability basis. Because remember, folks, and this is what I used to tell my students, if there was a strategy where you beat the house, and by the house I mean market makers and the algos and the high frequency traders, where you beat the house every time, well, everybody would be selling their grandmothers. They would be selling their furniture. They'd be selling their diamond rings. Because if you're always going to win, then why would you not, make a career out of this? And the answer is because the house basically always has the edge. So anyway, I think that is about it. And so I hope everybody got something out of this, and I hope you can see the way that the probability analysis actually plays into the rationale for the road trip trade and the rationale for the adjustments.
Well, that's great, Dan. There's already a request for the slides, and then Edward asked, are there other option strategies that work on the Monte Carlo simulator besides the road trip?
They will all work. I have shifted over now to the live screen. And so when you click over here on the home, this is what's going to come up, and you can try example trades. And so just as an example, let's stick in an iron butterfly. And so this is going to default to these numbers. And watch what happens when you generate the risk chart. So you got the payoff curve. I mean, it sits entirely within the bell curve. And now take a look at the simulation. You come down here, and it's going to cost you $610. And you have a negative expected return, and the probability of break even is less than 50%. And you'd expect this. And let me do one more. I'll do a Condor. I'll do an iron Condor. So this is with a theoretical stock price at 50, and they're doing a 55.45, and once again, the payoff curve is sitting entirely within the bell curve. We don't want that. When you run the simulation, you get, it's going to cost you $215 for this particular one. You get a negative expected return. You do get a slightly better than break-even chance. I mean, a slightly better than 50%, coin toss, a chance of a break-even. Not much, but a little better. But the key thing for me is you have a negative expected return. And this is what I noticed when I was developing the Weirdor. I said, you got to do something to fix this. And so simply by adding the debit spread to the Condor, at the time of launch, that's going to give you a positive expected return. And so, to answer your question, there are lots of other strategies that you can use. Okay.
All right. Anything else, Dan? We're just over an hour, so this seems like a pretty good place to stop.
Yeah, I think that's about right. Yeah, that was basically all that I had when we went over everything, and I think I answered the questions that came in on the posts, and but nothing else on this really, other than to try this simulator for yourself if you don't actually believe me, and you'll see that things, I mean, everybody, that the house always has the edge, otherwise they're not going to give it to you. And so we have to take the edge back, and that's what Tom and I have tried to do with the road trip trade, and we know that it works.